Chapter number 1, Introduction to Cost and Management Accounting. Measure of cost unit basis. Electricity, kilowatt hour, steel, ton, gas, cubic feet, brick making, 1000 bricks, coal mining, ton, engineering, contract or job, professional services, chargeable hour, job, contract, hospitals, patient day. Cost control. Cost control aims at maintaining the cost in accordance with the established standards. It seeks to attain lowest possible cost under the existing conditions. It emphasizes in past and present. It is a preventive function and ends when targets are achieved. Cost reduction. Cost reduction is concerned with reducing cost. It challenges all standards and endeavors to improve them continuously. It recognizes no condition as permanent. It emphasizes on present and future. It is a corrective function and has no visible end. It is a continuous process. The operational level staffs like supervisors, foremen, team leaders require the cost and management information to know the objectives and performance goals, to know about the product and service specifications like volume, quality, quantity, and the process, etc., to know the performance parameters against which their performance is measured and evaluated, to know the divisional profitability, etc. There are four types of responsibility centers: the cost centers, the revenue centers, the profit centers, and the investment centers. The cost centers are held accountable for incurrence of costs which are under its control. Performance is measured against predetermined standards. There are two types of cost centers: standard cost center and discretionary cost center. Revenue centers are held accountable for generation of revenue, for example, sales department. Though revenue centers do not have control on all expenditure it incurs, but some expenditure relating to selling activities like commission to salesperson, etc., are incurred by revenue centers. Profit centers are responsible for generation of the revenue and incurrence of expenditure. Profitability is the basis for measurement of performance. For example, decentralized branches. Investment centers are not only responsible for profitability but also has the authority to make capital investment decisions. Performance is measured based on return on investment ROI besides profit. Cost accounting records quantitative aspect only. It records the cost of producing a product and providing the services. It deals with cost ascertainment. It uses both present and past figures. Its development is related to industrial revolution. It follows certain principles and procedures for recording cost of different products. Management accounting records both qualitative and quantitative aspects. It provides information to the management for planning and coordination. It is wider scope. It includes financial accounting, budgeting, taxation, planning, focused with projection of future figures. It develops in accordance with the modern business world. It does not follow any specific rules and regulations. Industries and method of costing: real estate, contract costing, motor repairing workshop job costing, chemical industry process costing, transport service operating costing, assembly of bicycles unit output costing, biscuits manufacturing industry batch costing, power supply companies operating costing, car manufacturing industry multiple costing, cement industry unit output costing, printing press job costing, oil refineries process costing, interior decoration job costing, airlines companies operation costing, advertisement job costing. Opportunity cost is the value of sacrifice made or benefit of opportunity foregone in accepting an alternative course of action. For example, a firm financing its expansion plan by withdrawing money from its bank's deposits. So, the loss on interest on the bank deposit is the opportunity cost by carrying out the expansion plan. Impact of information technology in cost accounting. After the introduction of ERPs, different functional activities gets integrated. It provides custom-made reports. Reconciliation process of results of both cost and financial accounting systems becomes simpler and less sophisticated. It creates a paperless environment. IT with the help of internet, including intranet and extranet, helps in providing resource procurement and mobilization. For example, production department can get materials from the store without issuing material requisition note physically. Similarly, purchase order can be initiated to the suppliers with the help of extranet. This enables an entity to shift towards just-in-time approach of inventory management and production. Cost information for a cost center or cost object is ascertained with accuracy in timely manner. Each cost center and cost object is codified. This automates the cost accumulation and ascertainment process. For example, job-wise, batch-wise, process-wise, cost center-wise, etc. Uniform reports, budgets, and standards, irrespective of the location, currency, language, and regulations, are being prepared with the help of information technology. Cost and revenue variance report are generated on real-time basis, which enables the management to take control measures immediately. It enables to monitor and analyze each process of manufacturing or service activity closely to eliminate non-value added activities. Purchase of bonds, stocks, or real estate property are investment center. Ticket counter in a railway station is a revenue center. Decentralized branches of an organization are profit center. Maharatna, Navratna, and Maniratna, public sector undertaking of central government, are investment center. Sales department is a revenue center.